How do you piece together higher interest rates, inflation that is a bit hard to predict, onshoring, war economy? Is this going to be a very interesting time ahead to see how the inflation and interest rates will go? Because it's very, from my perspective, it seems like maybe harder to predict than people expect, because I feel the narrative is that they're going to drop quite soon and then let's see. But I'm not so sure that it's that easy with inflation, given the geopolitics, onshoring, and all the initiatives from big countries like US, etc.
If you look back in 2008, Lehman Brothers was crushed, and this the Fed doesn't want to happen again. I think that's quite clear. So what they did last year, when you had all the problems with Silicon Valley Bank and other regional banks, they just poured money into the system. So they had used the brakes at the same time as they went full speed forward. And this obviously keeps inflation up. It does. And another thing that is easy to forget is sort of that, especially when you sit in Norway, is that in Norway and Sweden, people feel the interest rates immediately because they have floating interest rates. In Denmark, you had a situation where a lot of people went from 30-year fixed to 5-year fixed, and then they could pay back a lot of the loan through that. So in Denmark, kind of, you haven't really seen the effects of the rising interest rates because people have actually made a profit from it in many cases. And down in Europe, rest of Europe and Switzerland, people have fixed interest rates, and in the US as well. So it's kind of the new builds and the first-time buyers that are exposed towards interest rates. And at some point in time, they will feel it for real, yes, but it takes time. And so this is what makes it a bit tricky. I think you have this, as you say, this war economy, the liquidity is poured in. People are having jobs. They get paid a bit more every year. And when you look at it, a lot of homes at the moment is quite affordable as well for people who receive normal salaries, because yes, you kind of they have always just been borrowing 5 times income, for example, and they do that now as well. And so the banks since 2008 have sort of put into their equation that you can't borrow more than 5 times your income, for example. And so if the interest rate is 5 or 3, it takes a lot of time before it actually really tightens the economies, except for Norway and Sweden.
So how do you feel it's going to play out? What are the signals you look for the most yourself when you're trying to, map out the scenarios? And you maybe also will be an interesting year with US election as well. Seems like that's going to be a very interesting election.
So I think it's quite clear that the US, I mean, if you look at their state finances, it doesn't really make sense at all. But in an election year, I think we'll be fine. They will save the consumer. And this is kind of part of the issue in many other places than the US, that a lot more politicians than before are just pouring money into the economy. And so that will in turn create inflation. But at the same time, higher inflation is and higher interest rates are biting into many companies. And if you look at the high yield market, for example, in the States, I mean, you have a lot of companies that are cash flow negative, especially if they when they refinance. And this is where it's going to be exciting, and at some point the market will break. But it's just taking more time than the average Norwegian analyst would predict, because of this floating fixed interest rate scenario.